The US blames Iran for an attack on 2 oil tankers in the Gulf of Oman, sparking a surge in crude prices and heightened tension in the Middle East. It had been a fairly quiet week in financial markets right up until about 10 a.m. Thursday morning local time in Oman, when news started to filter through global media of a reported oil tanker fire in the Gulf between Iran and the UAE. When the press started to report that in fact 2 vessels were on fire, one of which had been hit by 2 shells 3 hours apart, crude oil prices surged higher. Brent crude oil jumped as much as 4.5% on the news, providing a stark reminder of the state of tension in the region. US Secretary of State Pompeo was quick to blame Iran on the basis of intelligence, the weapons used, the level of expertise needed, and recent similar Iranian attacks on shipping in the region. Now, Japanese Prime Minister Abe was meeting Iranian Supreme Leader Ayatollah Khamenei at the time of the attack. After the meeting, the Iranian leader said he had no trust in America. Now, about 16.8 million barrels of crude oil passes through the Straits of Hormuz per day, emphasizing just how critical this choke point is to the global economy. And UN Secretary General Guterres quickly stated that he strongly condemns any attack against civilian vessels. Away from crude markets, global sentiment has been more upbeat this last week. The agreement between Mexico and the US to avert tariffs, announced after the close of markets on Friday last week, helped equities around the world gain ground, aided by rising expectations that the Fed will cut rates. While money markets are pricing in closer to 70 basis points of cuts by the Fed by year-end, Westpac has changed its forecast and is now forecasting 2 rate cuts from the Fed in September and December, meaning that next week's FOMC meeting and press conference will be key for financial market sentiment. We expect to see the Fed being open-minded towards cuts, patience potentially replaced by a promise to act as appropriate, and the so-called dot plots likely to see a clear dovish tilt. Here in Australia, we've had a wealth of information on the Australian economy. We saw a rather mixed result in the May NAB business survey, with confidence up post-election, but trading conditions, forward orders and employment all soft. The Westpac June consumer sentiment was also quite patchy, but overall disappointing, with the index down slightly compared to the usual sharp bounce on a rate cut. Australian consumers seem understandably more concerned about why the RBA cut rates. The eagerly awaited May labour force data also saw a mixed set of results. On the positive side, jobs growth beat consensus for the 3rd straight month, up 42,000. Over the year, jobs growth continues to run faster than GDP, while full-time employment is rising at 3.1% on the year. However, the job surge has encouraged more potential workers to return to the market, and thus a record high participation rate, which kept the unemployment rate at 5.2%. The RBA says it would like to see the unemployment rate nearer to 4.5%, so there's extra interest in Governor Lowe's speech on the labour market and spare capacity announced for next Thursday, 2 days after the RBA minutes from the June 4 meeting are released. Market pricing for a July rate cut rose to 75% as market focused on the higher than expected jobless rate, and heightened expectations of RBA rate cuts added to the weaker price action in the Australian dollar, which hit 2-week lows at 69.02 on Thursday. This was despite renewed tightness in global iron ore markets, which saw prices in Singapore futures hit fresh 5-year highs. Now, given the focus that the RBA governor will likely apply to spare capacity in the labour market next week, the Aussie dollar may continue its recent slide below 69 cents. Aside from the RBA minutes, Lowe's speech and the FOMC meeting next week, we also have the Bank of Japan and Bank of England policy meetings on Thursday too. Neither central bank will touch policy, though comments from Governor Carney will be closely watched, coming as the Tory leadership process continues. Boris Johnson saw a commanding lead in the first round, adding to risks of confrontation between the UK and Europe over Brexit. And finally, of course, Trump and Xi will be closely watched through the coming week for signs as to whether they will or will not meet at the following week's G20 meeting. Trump yesterday said he expected to meet Xi on Osaka, but he did describe trade relations at the moment as a bit testy. These are all factors we'll talk about in next week's Markets Update.